On Business Incorporated today, African Development Bank and Japan announced $5 billion support for Africa's private sector. IMF projects Liberia's growth rate at 5% despite global economic downturn. In global stocks, hit one-month low as dollar advances. Hello and welcome to the program. I'm Will Ibang. Let's begin as usual with market numbers at intraday. We see major markets in Africa are negative, starting with Nigeria's NGX, which has lost its positive steam after the positive close over the week. It's down at intraday marginally by 0.01%, while South Africa also dipped 1.57% to close at 69,068.16 points. We see over to the Middle East where negative sentiments, mostly negative sentiment persisted there. 0.1% down for the Egypt's index. Kenya closed Friday's session 0.63% down. Now we move to Europe where there's a warning that the EU is facing up to a decade of terrible winters if it doesn't act up to tackle high gas prices. Meanwhile, the German government plans to help households struggling with soaring prices to avoid this negative trend that we're seeing. Rob West is in Berlin with the details. Rob, Europe are being warned that they face a decade of difficult winters. What is the concern here?
Well, they've got a major problem on their hands and have had ever since Russia invaded Ukraine back in February. Not just the war of itself, obviously, but the impact that it's had on Europe's supply of natural gas. Not only has the war driven up the price of gas to many times what it was at the start of the year, but Russia would also appear to be deliberately throttling the EU's supplies. So now Belgium's energy minister has warned that the bloc faces 5 to 10 years of what she called terrible winters if it doesn't act quickly. Tina van der Straaten says there's an urgent need for the EU to introduce a Europe-wide cap on the price of gas, and also that the price of gas needs decoupling from the cost of electricity bills. Bills have been surging for many Europeans. Electricity prices actually just hit a record high. They're around 10 times what they were a year ago in Germany and France. And there is a real fear that many households won't be able to cope as the winter arrives. One of the problems is the major role that Russian gas plays in Europe's energy supply, so reducing that reliance on Russia has become a priority. Germany was the biggest importer of Russian gas, but there's at least been some good news there. The government says it's on course to meet its target of filling up its natural gas reserves ahead of schedule. It wants to have 85% of its storage capacity full by October to make sure that there is enough for the winter should Russia continue to slash supplies. And the economy ministry says that Germany is likely to achieve that target as soon as early September.
So the German government is formulating new measures to help with the soaring prices. Do you know what they have planned?
Well, we're starting to gain an idea. Reuters says it's seen a document outlining proposals from the SPD, the Social Democratic Party, who are the largest party in Germany's ruling coalition. What a lot of people are keeping an eye out for is what the successor is going to be to the €9 ticket that has allowed Germans to take public transport all over the country for just €9 per month since June. €9 is actually about what you'd normally pay for a day ticket here in Berlin, so it's a big slash to the price. The aim was to get people onto the public transport network and therefore cushion the impact of rising petrol and diesel prices, and it seems to have been successful in doing that. But that scheme is due to end this week. So what comes next? Well, the document seen by Reuters suggests that the SPD wants something similar, but instead of €9, the ticket will cost €49 per month. That still represents a big reduction in most parts of Germany. The Social Democrats Democrats are also proposing direct payments to middle and low-income households to help them with energy bills. They also want to protect tenants from evictions if they can't pay their monthly costs, which often include heating. And the SPD is also proposing including heating costs in the housing allowance that Germans can claim. So this third package of relief measures since Russia's invasion of Ukraine is set to be discussed this week, along with also proposals for an electricity and gas price cap.
So how are markets reacting to all this? What's the market outlook for, well, what's the market looking like today, Monday?
Well, Monday trading is actually being dominated by developments in the United States. From Friday, Federal Reserve Chairman Jerome Powell said the central bank would continue to raise interest rates to curtail inflation, even if that is causing pain to American households and businesses. So at the start of the trading week, Asian shares slipped 2%, largely as a result of Jerome Powell's comments. And then European markets will also react to that, along with comments closer to home over the weekend. European Central Bank board member Isabel Schnabel said on Saturday that central banks around the world risk losing public trust and need to act now to tackle inflation, even if it does drag their economies into recession. So aggressive rates hikes are looking increasingly likely in Europe and the United States. Investors in the Eurozone are actually anticipating an increase of as much as 75 basis points next month here. Now, the ECB, of course, oversees the euro, and that's also worth a mention today. It slipped to a near 20-year low against the dollar. It's currently trading at below the value of the dollar, having dropped below parity for the first time in 2 decades in recent weeks. And the dollar got another shove up in value from Friday's comments by the Federal Reserve Chairman.
Thanks a lot, Rob, for that update. We'll look forward to what's going to happen tomorrow. Now, over to Asia, where shares traded lower today following Fed Chairman Jerome Powell's speech at Jackson Hole. On Friday, he warned that rising interest rates will cause some pain to the U.S. economy, saying higher interest rates likely will persist for some time. The Nikkei 225 in Japan slipped 2.66% to 27,878 points. Shanghai in China rose 0.14%, while the SHI in also dipped 0.75% to close at 20,000 points. The Kospi in South Korea dipped 2.18%, and the ASX 200 in Australia also dipped 1.95%. Mainland Shanghai's composite rose, as I mentioned, 0.14%, and that's due to the comments from the Fed's Chairman Powell's speech on the inflation rate. Now, oil prices were mixed in early trade on Monday as expectations that OPEC will cut output to support prices against concerns backed by Federal Reserve Chairman Jerome Powell's speech, saying the United States will face slow growth for some time. U.S. West Texas Intermediate crude futures rose 2 cents to $93.08 a barrel, adding to Friday's gain, and the dollar index continued to climb on Monday to $109.16, up 0.3% in early trade following Federal Chairman Jerome Powell's speech. A stronger dollar weighs on oil as it makes crude more costly for buyers holding other currencies. However, oil prices have been buoyed by talk from Saudi Arabia and other members of the Organization of the Petroleum Exporting Countries and Allies as OPEC Plus that they could cut output in order to balance the market. The United Arab Emirates is aligned with the Saudi thinking on output policy. Source said, while the Omani Oil Ministry also said it supports OPEC Plus efforts to maintain market stability. Sources last week said OPEC would consider cutting output to offset any increase from Iran should oil sanctions be lifted if Tehran agrees to revive a nuclear deal. Now, gold prices fell early on Monday as the dollar held on to gains following U.S. Federal Reserve Chair Jerome Powell's signal that central bank will raise interest rates further to tame sky-high inflation. Spot gold fell 0.3% to $1,732.17 per ounce after falling 1.2% on Friday, while U.S. gold futures were down 0.3% at $1,745.30. Gold premiums in top consumer China jumped last week to their highest since October as a fall in global prices encouraged purchases, while demand cooled in India as buyers waited for a bigger price drop. Spot silver fell 1% to $18.69 per ounce. Platinum slipped 1% to $855.27, and palladium was flat at $2,110.19. The U.S. Now we'll take a break now. When we come back, the U.S. dollar is on the move again following Jackson Hole summit. And how much impact will that have on emerging economies? That conversation right around the corner. This is Business Incorporated. Now in the UK, shock of the pandemic has eased, but the warnings that high inflation will hit the retail sector is what's looming, and that doesn't sound good for the high streets. Now, Juliana is in London to give us more updates on that. Hi, Juliana.
Hi, Will. Hopefully you can hear me clearly.
Yes, I can, Juliana. Juliana, closures in the first 6 months of 2022 dropped by a third compared to the first half of last year. I thought trading had gone virtual.
Yeah, this is a piece of research which has been conducted by PricewaterhouseCoopers, basically looking at the landscape of retail. And when we think of retail, we typically think of places we go to when we're shopping for clothes. But of course, the retail space is much more vast than that. And it does include banking institutions, the post office, which is a traditional institution here in the UK. And their research has basically shown that the shake-up that we've been speaking about may have passed, because for the first time in 7 years, they are showing that the trajectory of closures could be over. Now, there were so many closures. We were speaking about it almost every day during the pandemic. A lot of these reasons is because people were going online. More and more people were not using a bricks and mortar bank to do their banking. They were going digital. And now we seem to have come out on the other end of that. PricewaterhouseCoopers say that only 6,000 stores or so closed in the first 6 months of this year. If you compare that to last year, I think that's fallen by about 30%, which is obviously really important. The hospitality sector and pop-up shops, coffee shops, they've really taken advantage of the fact that so many big stores have had to clear out their goods, and they've been able to get in there on discount rates. I think another story that's worth mentioning, Will, which has been brewing here in the UK, seems to be this invasion of Oxford Circus, which is a really prominent destination here in the UK, of American candy stores. Now, this is a big shame because, of course, if you come to the UK, you want to see some of the iconic stores. You're not really seeing that anymore. The landscape is still changing, but I think the fact that PwC have found that closures are starting to decline is good news for a landscape that's really important to the British economy.
Speaking of the economy, you know that it's a bank holiday today in the UK. How are markets and other businesses reacting to this report and other stories that are developing in the country?
It is a bank holiday in the UK, Will, which is why I'm here and which is why you didn't see me this morning. But it's a pretty quiet week. I think the main talking point has got to be this Conservative leadership race. It's been going on and on and on. It finally comes to an end on Friday, so the ballot will be closed. And then on Monday, we are going to find out who is going to succeed the embattled leader of Boris Johnson. Now, of course, the odds on is that it's going to be Liz Truss. In fact, you can't read a newspaper or switch a news channel without seeing all of Liz Truss's sound bites. It seems as if the media firmly put Rishi Sunak in the bin. But of course, there are so many things that she's got to tackle. And the main thing, of course, is the cost of living crisis and record high levels of inflation. Energy bills are skyrocketing. I just got my energy bill for the month of September. It's going to cost me over £350 just to heat my home, which is an absolutely staggering amount. The vast majority of people in this country cannot afford to pay these high bills, which are going to be higher. So there's lots of media rounds at the moment trying to outline what exactly this trust is going to do. Will she be cutting VAT, which is what the Times are reporting? Is she going to be giving people cash handouts? We'll just have to wait and see. But yeah, pretty quiet week. I'll be back in the studio, hopefully looking a bit fresher, a bit more filtered on this. Yeah, updating you and all the other bits and bobs that's going on in the capital, Will.
Definitely, Gina. I look forward to seeing you tomorrow on the bigger screen. Thank you so much, Juliana. Now to other stories on the continent, African continent. Japan and African Development Bank announced up to $5 billion in support for Africa's private sector. The African Development Bank and the government of Japan have announced a $5 million financial cooperation under the 5th phase of the Enhanced Private Sector Assistance for Africa initiative. The announcement was made at the 8th Tokyo International Conference on African Development, that's the Ticket 8 in the Tunisian capital, Tunis. The funds consist of $4 billion under the existing window and an additional up to $1 billion that will be provided under a new special window. Japan will establish this special window to support countries that are making progress in the enhancement of debt transparency and sustainability and other reforms, thereby making steady and significant improvement in their debt situations. The newly signed initiative will positively impact millions of lives across Africa and will cover priority areas such as electricity, health, agriculture, and nutrition. And Federal Reserve Chair Jerome Powell's signal of higher for longer interest rates cursed through markets Monday, sinking stocks and equity futures and lifting 2-year Treasury yields to levels that have not been seen since 2007. A global share index fell to a 1-month low as in the European markets and U.S. futures tumbled. Tech firms led losses for Asian equities, while progress in the U.S.-China delisting spat help to cushion Chinese stocks. The Bloomberg Dollar Spot Index pushed towards the record hits last month as investors sought a haven from spiking volatility. Commodity-linked currencies, as well as the yen, the pound, and the offshore yuan, were also under pressure. Bonds sold off and a deepening inversion of the Treasury yield curve underscored expectations of a recession as monetary policy tightened. The U.S. 2-year yield, sensitive to expectations around Fed policy, hit 3.47%. Now, the International Monetary Fund, IMF, has predicted that despite global development's downturn dampening economic growth at 3.7% this year, Liberia easily has the potential to grow at least 5% annually. The news comes as IMF Executive Board completed its 4th review under the Extended Credit Facility Arrangement and concluded the 2022 Article for consultation for Liberia. It said quantitative program performance was quite strong, while the implementation of the structural reform agenda incurred delays. Adoption of new anti-corruption legislation was also in good progress. At the same time, the fund observed that entrenching macroeconomic stability, achieving strong and fiscal sustainable economic growth, and addressing weaknesses in governance and public sector institutions remain the main program objectives. The Liberian authorities continue to implement sound macroeconomic policies despite delays with a broad-based reform agenda. The authorities managed to keep the program broadly on track by preserving macroeconomic stability, ensuring a comfortable international reserve position, and maintaining debt sustainability. Macroeconomic stability is set to strengthen further with the planned modernization of Liberia's monetary policy framework, and the ongoing currency changeover provided operational risks are appropriately mitigated. Liberia experienced a strong economic recovery in 2021. Growth is expected to soften to 3.7% in 2022, largely due to heightened global uncertainties and commodity price shocks, which are pushing inflation into double digits. Now, last week, the U.S. Fed Chairman Jerome Powell's comments of more interest rate hikes at the Jackson Hole Summit sent jitters across markets. Powell's tough stance against inflation is further strengthening the dollar, and the impact of this is creeping up on many emerging economies. Opelua Dapo Thomas joins me to share his insights on this and the possible impact many economies may face. Hello, Dapo. How are you doing today?
Hello, how are you doing? Thank you very much for having me today.
So we heard and we saw the Fed chairman's speech on further interest rate hikes on the U.S. economy. How does this impact currencies from other emerging economies?
Well, a stronger dollar obviously has an impact on currencies. I mean, we've seen how the dollar has impacted them with the euro. Now we have euro parity. I mean, the last time the euro and dollar was about the same level was 10 years ago. And so we've seen that now achieve. It was about 20 years ago, by the way. Now we're seeing that happening. The dollar has obviously gone up 15% against the Japanese yen. It's gone up 10% against the Great British Pound, and possibly missing to a 37-year low against the British Pound. But the biggest impact obviously is on emerging economies, especially because emerging economies have a lot of debts to pay. So we're looking at a lot of countries facing default risk. They can't pay back their debt. Countries such as El Salvador, Pakistan, Argentina, Ukraine, Ghana, Kenya, Egypt, Tunisia, they're having troubles trying to pay back debts because obviously the dollar is stronger now, and now they have to seek external financing. That's why you see countries like Ghana going back to IMF, asking for credit lending facility about 3 to 4 years. So that's the biggest impact, obviously, and that's what we saw Sri Lanka collapse a few months ago. There's no more FX in the country, obviously, and to pay their debts and even to import. And import, obviously, is now where the biggest problem is, because obviously the US is self-sufficient in most of the commodities they have. So there's a lot of commodity protectionism that we're having, because the pandemic obviously has made every country try and look for self-sufficiency to be able to plug in the gaps. So countries that have to import commodities are obviously going to suffer, because the commodity prices are rising, then two, the dollar, which obviously is the currency used to buy commodities, is also rising. So you're going through the double whammy of that. So this is the wrong time. This is the wrong time to be importing commodities into your country. But then again, most of the emerging economies are they are large importers of these things because they don't have the facilities to produce on their own. So this is a very time to be an emerging economy in terms of paying back debt, because you can't pay your principal, you can't pay your interest back. It's now more expensive, so you have to kind of seek more debt to pay your debt. And that's why you see, for example, countries like Ghana moving in from 65% public debt to about 80% public debt to GDP. So these are the issues that emerging economies are facing.
Now, so you mentioned the import-dependent countries such as Nigeria, Ghana, and the rest of them. And you say this is the wrong time to be importing at this time. But we see Ghana and Nigeria still struggling with the FX, and they can't but help to import because they don't have enough to, they're not self-sufficient yet. So does this dollar strengthening, this stronger dollar, as in this exchange rate problem you're having, does it further stoke the FX scarcity we're experiencing in the country and in other parts of Africa?
Oh, yes, it does. Like I said, look at what happened in Sri Lanka. There's no dollar again because obviously you have to pay back your debt. So right now, let's look at Nigeria's fiscal position. Nigeria's fiscal position is very, very grave because we obviously are into some sort of subsidy payments. Now, subsidy payments means that this is the best time to be an oil exporter. But in Nigeria, the reverse of the case. Is quite paradoxical that we're not making money from oil. Look at Qatar making about $54 billion in the first half of the year. Saudi Arabia makes $1 billion every day from exporting oil. But the oil that Nigeria exports, when the money comes in, takes it out to go and buy refined petroleum products. And that's where the problem is. So there's no much dollar to finance their debts, because the money goes back to buy petroleum dollars. And obviously petrol is a commodity, and commodity prices are rising. So obviously the current price of oil is affecting the Nigerian economy. It's the same thing with Ghana as well. Ghana has not even survived the pandemic, and now we are now having the issue in Ukraine, obviously, which has exacerbated a lot of commodity issues with grain. Most of these people import this type of things. So Ghana has come back to IMF, who have said they are going to look at programs that can help with their anchor debt sustainability and macroeconomic stability. But the truth is, it's quite tough for this countries. They have to seek external financing. But Nigeria has already looked at all the Eurobonds possible. Ghana obviously is looking at IMF and everything, trying to get more money. About $3 billion credit facilities, what we're talking about. So it's quite tough to be an African.
We hope that this problem gets, evened out very quickly and probably reduced. Thank you so much, Dapo, for your insights on the program.
Thank you very much.
And that's it on Business Incorporated. I'm Will Ibang. Thanks for watching.